Welcome to the Deep Dives. Okay, let's just jump right into the data today.
Sounds good.
Because, well, if you've been watching the markets, I think you know exactly what the crowd is doing right now.
Oh, yeah. It's all about chasing sheer momentum, isn't it?
Totally. We're seeing just massive enthusiasm for what the research we're digging into calls high beta home runs.
Right, that phrase. It basically captures those really speculative names, often unprofitable companies.
In those hot sectors.
Exactly. AI, advanced robotics, quantum computing, even some nuclear energy plays. Everyone seems to be searching for that huge, quick spike.
It's definitely exciting. You see the headlines, but
Yeah.
well, the analysis suggests it's mostly noise right now.
A lot of noise, yeah.
And all that noise seems to be creating this really fascinating market anomaly. So our mission, really, for this deep dive is to analyze why, according to the source material we've got, high-quality stocks HQS might actually be the big opportunity.
The overlooked opportunity.
Right, how their underlying structure, their composition, provides this sort of critical blend of offense and defense that the market seems to be, I don't know, completely ignoring.
Yeah, ignoring in its current, let's call it a sugar rush. Good way to put it.
And it really is a remarkable disconnect when you look closely. The data clearly shows that while those speculative names have been, rocketing higher since the market lows back in April, the quality sector has just been quietly and actually pretty dramatically left behind.
And when we say left behind, we're not talking a small amount. The S&P 500 Quality Index that tracks the top 100 quality names, it's trailed the broader S&P 500 by, a staggering 9% over just the last 6 months.
9%.
9%.
Yeah, and to give that some context, that 6-month window, starting from those April lows, it marks one of the weakest stretches of underperformance for the quality factor ever recorded. Seriously.
And
that's what the data suggests. This isn't like normal behavior for these types of fundamentally sound companies. And that's the real kicker, isn't it? We're not talking about struggling businesses here. When you look at the list of giants that have lagged, these are supposed to be the best of breed stocks. Immaculate balance sheets, strong fundamentals.
household names, often.
Exactly. We were talking about Apple, Visa, Coca-Cola, Eli Lilly, Costco. It's almost jarring, right, to think that Apple and Coke are the underdogs here.
Lagging behind companies that maybe haven't even turned a profit yet. It's kind of upside down.
It really feels that way.
That's exactly right. The market's clearly rewarding speculation over substance at the moment, but, history tends to tell us that this precise setup when quality goes on sale, essentially.
It gets discarded.
Yeah, it gets discarded in favor of the pure growth narrative, the exciting story.
Right.
That's the time when, informed investors really need to start paying very close attention.
Okay, let's unpack that with some real substance then.
Yeah.
Before we can talk about why they're an opportunity, we need to properly define what we actually mean by quality, because it's not just a subjective thing, right? It's not just, I like that company's reputation.
Not at all.
The research we looked at provides a really clear quantitative checklist.
Right.
So what are those core fundamental attributes? I think there were 3.
That's right. 3 key things. And these really form the structural bedrock of the quality factor. If a company doesn't meet this checklist, it just doesn't make it into the index. Simple as that.
Okay, so number 1.
First, HQS must demonstrate high returns on equity, ROE. It basically tells you how efficient they are with the capital investors give them.
Right, efficiency.
Right.
So they aren't just growing the top line, the revenue, they're actually maximizing the profit generated from the money that's been put into the business.
Precisely. Really effective capital deployment.
Okay, makes sense. Number 2.
The second attribute is stable year-over-year earnings growth. Key word being stable or maybe consistent is better. We're looking for that consistency, not, massive spikes followed by big crashes. Reliability.
Predictability, almost.
To a degree, yes. And crucially, the third factor is that they have to maintain low financial leverage.
Low debt.
Low debt, exactly. A small debt load relative to their earnings and their assets.
Okay, I get the ROE, that makes sense, and the earnings stability. But let's pause on that low financial leverage point for a sec. Couldn't high ROE sometimes suggest a company is taking on maybe too much risk to juice those returns?
Yeah.
How does the low debt factor actually square that circle, especially now?
That's a great question. And that's sort of the genius of the quality screen working together. That low leverage factor, it acts as the ultimate safety net, really, and the long-term differentiator.
How so?
Well, think about it. When interest rates are high, like they have been,
Mm.
companies with huge debt loads get absolutely crushed by higher financing costs, right? It just eats directly into their earnings. But these high-quality names, the ones screened for low leverage, they're much more insulated.
Because they're not borrowing as much.
Exactly. They're funding their growth internally, mostly through their own profits or maybe through very small amounts of debt that's often cheaper anyway because of their quality rating.
Okay, so low leverage equals resilience.
Yeah.
It buys them operational flexibility, gives them defense against economic shocks, or, like you said, interest rate hikes.
Spot on.
It makes perfect sense then that quality, defined by those three attributes, probably never goes out of style for too long.
And that's absolutely reflected in the historical data this research highlights. Since 2005, and think about what that period covers, multiple boom-bust cycles, the global financial crisis.
A lot.
Through all of that, buying the dip in these high-quality blue chips has consistently paid off. The assertion in the material is actually very strong on this point.
Which is?
Basically, if you are not buying quality when it shows this kind of weakness, you probably shouldn't expect to beat the market over the long term.
Wow, that's a bold claim.
It is, but they back it with data going back almost 2 decades. So this current 9% lag we're seeing, well, it starts to look less like a problem with quality stocks.
And more like,
More like a major, historically supported window of opportunity, a sales sign, essentially.
okay, that transitions us perfectly to the sort of bigger picture context here.
Yeah.
Because this isn't just about finding simple historical value, like buying something cheap. It sounds like it's about getting ready for what might happen next in the market cycle.
Yes.
The analysis suggests the quality trade is actually really well positioned for, well, the inevitable market rotation.
Precisely. Bull markets rarely climb indefinitely, just on the backs of the same few stocks, right?
Mhm.
They rotate, leadership changes.
Always happen.
And the source material points out that we've seen these long-standing cyclical leaders, mostly in tech, let's be honest, consolidate absolutely massive gains over the last year or so.
They get expensive.
They get expensive, exactly. And investor money, naturally, starts searching elsewhere for potentially better risk-reward profiles, hunting for value or the next leg up.
So when the leader, the star player, gets a bit heavy and pricey, the rest of the team starts to catch up.
Well put.
And that seems to be exactly why this quality rotation idea is potentially so powerful right now. Because those quality defensive names, think healthcare, staples, maybe certain industrials, they're finally beginning to perk up, just as that initial tech momentum seems to be maybe slowing down a bit.
And the structural difference between the broad S&P 500 index and this quality index is just staggering when you look under the hood. It makes the quality index potentially far more resilient to that kind of rotation risk.
Okay, let's get into that. The index concentration comparison. Because the numbers here, when I first saw them, were genuinely shocking.
They really are.
If you look at the top 10 highest weighted companies in the standard S&P 500, all but one of them is a technology company.
All but one. The exception being Berkshire Hathaway, which is, its own unique beast.
Right, but still, that is an enormous concentration of risk in just one sector.
It really is. It arguably creates a massive single point of failure, or at least vulnerability for the broader market if tech suddenly rolls over.
But then you look at the high-quality index top 10.
And the picture shifts dramatically. There are only 2 technology companies in that top 10, Apple and Salesforce. And, importantly, the research specifically notes that neither of those is trading in what they call nosebleed territory valuations.
So not the super high flyers.
Not necessarily, no. And instead of being dominated by those big momentum tech names, the HQS top 10 includes, 2 major financials, 3 staples, and 3 industrial stocks.
That's built-in diversification right there, isn't it? Just
Yeah.
baked into the top holdings.
Absolutely. It's structurally designed that way.
We can probably get even more granular on those sector weightings, right? Because the percentages really tell the story about the defensive posture.
They really do. So in the high-quality index, technology makes up just 23% of the total weight. Now compare that
To the S&P 500,
where tech holds a massive 36% of the weight.
36%.
Yeah. So the quality index has intentionally shaved off, over a third of the sector-specific risk exposure that really defines the broader market right now.
That is a significant difference in philosophy, not just holdings.
It absolutely is. And it gets maybe even better when you look at the truly defensive sectors.
Like staples, healthcare.
Staples, healthcare, and industrials. The sectors that tend to hold up better when economic growth slows down, they have a combined weight of 51% in the high-quality index.
51%. Half the index in defensives.
Over half, yeah. Now compare that to the S&P 500, where those same three critical defensive sectors have a combined weight of, well, a paltry 22%.
22%? Wow. So quality is over 50% defensive. S&P is barely over 20%. That's huge.
That's a fundamentally different construction.
Okay, so here's where it gets really interesting for me. The sort of powerful 1-2 punch, as the analysis puts it, of the quality index. You get this significantly more balanced distribution, right? Defenses own a larger share, basically creating, I don't know, an armored vehicle.
Yeah, like a shield.
But then that healthy 23% tech allocation ensures the engine still has enough horsepower, enough juice to keep the returns competitive when the market is roaring upwards.
Exactly. It's not just pure defense. It aims to participate meaningfully in the upside, too. It's trying to be both a shield and a spear, perhaps.
A shield and a spear, I like that.
And it results in what looks like a historically optimal risk-return profile based on the last decade of data they analyzed.
Okay, break that down. What does optimal mean here?
Well, first, quality tends to act as a higher-yielding portfolio compared to the S&P 500 overall.
Okay, higher income.
Yep. Second, and this is key, it captures about 94% of the S&P's upside movement. Think about that for a second.
94%. So you get almost all the gains when the market's climbing.
Pretty much, yeah. You're not sacrificing much growth potential at all.
But, and I'm guessing there's a but coming on the downside.
That's the real mathematical magic, as you put it. The quality index achieves that 94% upside, while historically carrying only about 95% of the S&P's volatility.
Okay. Less bumpy ride.
Significantly less bumpy. When you smooth out the ride like that, capturing nearly all the gains but removing some of that gut-wrenching volatility, those big drawdowns, the long-term compounding effect, can become dramatically superior.
Because you lose less during downturns.
Exactly. The analysis strongly suggests that avoiding those big losses, or at least mitigating them, is what ultimately allows this kind of strategy to outperform over a full cycle. Compounding works better when you don't have huge setbacks.
So let me recap. Less overall risk measured by volatility, almost all the upside participation, higher yield, and potentially superior compounding over time because you avoid the worst of the drops.
That's the historical picture, yes.
The sources seem very clear on the punchline here that if you buy that mathematically superior structure when it's effectively on sale,
like it arguably is now, lagging by that 9%.
The analysis suggests you have a good chance to actually beat the S&P 500 outright in the coming cycle.
That's the core thesis, yeah. That buying quality on weakness is the key to unlocking that potential outperformance.
So how do they suggest playing it? What's the strategy?
Well, anticipating a continued, perhaps rotating bull market, the approach they feature is what they call a barbell sector approach to quality.
Barbell.
Meaning you strategically ensure you have exposure to both cyclical quality names, those that tend to thrive when the economy is doing well, like certain industrials or financials perhaps.
Okay, one end of the barbell.
And then also non-cyclical quality names, the classic defensives like staples and healthcare that tend to hold up better when things inevitably slow down.
The other end of the barbell.
Exactly, you hold both ends.
I see. Because if you have both ends of that barbell represented within your quality holdings, you don't have to perfectly time the exact moment the market rotates from, say, tech leadership to defensive leadership.
Precisely. You don't need a crystal ball for the sector handoff. You aim to participate regardless of whether the market decides to favor, I don't know, defensive healthcare or maybe industrial leaders in the next 6 months.
You let the diversification that's built into the quality definition itself do the heavy lifting for you.
That's the idea. It's a strategy designed for consistency in what's often a very inconsistent market.
Okay, so let's try and summarize the bottom line here. What does this all really mean? The main conclusion seems crystal clear from the research.
Yeah, I think so.
High-quality stocks, defined by those specific metrics, appear to be currently undervalued, maybe significantly so, and they offer what looks like a historically rewarding opportunity.
Based on past performance during similar periods of underperformance.
Right. Their strong fundamentals meet that rigorous quantitative checklist: high ROE, stable earnings, low debt. And their diversified sector composition seems to make them ideally suited to benefit from these inevitable market rotations, especially when they're trading at this kind of historic discount to the main index.
And the central piece of advice, really distilled from the research we've reviewed, is Well, it's simple, but maybe not easy to follow in the moment.
Which is
Follow the data instead of the crowd.
easier said than done sometimes.
Yeah. Always. The crowd right now is clearly chasing that short-term momentum, often in unprofitable or highly leveraged companies. Meanwhile, the long-term data seems to point squarely towards consistency, substance, and resilience. Quality.
So, given that historical tendency we discussed, quality rewarding buyers who step in during these specific periods of weakness, which is exactly what this 9% gap looks
Yeah.
like, it really makes you ask, doesn't it? What does it actually mean to be early in this market cycle? Is
Yeah.
being early buying quality now? And maybe more importantly, how often does all that short-term noise, that momentum chasing, blind investors to the long-term consistency that actually drives sustainable wealth creation?
That's the million-dollar question, isn't it? The opportunity appears to be there. The data is quite compelling, according to this analysis.
The hard part, as always,
Is acting on the wisdom of Sudbury, or at least this interpretation of it, when all the headlines are screaming about tomorrow's next big splashy thing.
definitely something to chew on as you review your own portfolio and think about the next move. Great stuff. Thanks for diving deep with us today on this.
My pleasure. Always interesting to dig into the data.
We'll catch you next time on The Deep Dive.